Hi, I'm Devin Shute, and welcome again to the Money Minute. Now, as investors, we are currently living through one of these uncomfortable periods of volatility in markets. These times can cause us to question our strategies and dangerously be tempted to make short-term decisions that create long-term harm for our capital. So I thought what is always helpful to do is to take a step back and see how we're doing over longer periods. And actually, when looking at the JSE, it makes for some interesting reading right now, and we don't even have to look that far back. For example, if you'd taken a well-deserved holiday before Trump's tariff announcement at the beginning of April and just got back from your trip last week, you wouldn't have even known about the sharp sell-off markets had experienced there. You would have just seen that the JSE has reached record highs and actually been quite pleased with yourself. Now, those couple of weeks while you're away caused a lot of anxiety for investors who are watching the markets closely. What is also interesting is that if you look back further, the JSE has had a very strong 12 months, and this is contrary to how it feels with our political and economic concerns. Over the last year, the S&P 500, which represents the US companies, the biggest US companies around, is up 7%. While the JSE, measured in US dollars, is up almost 30%. Now, I'm the first to admit that the JSE has lagged the US market for many years. But the point here is that markets move in cycles, and no single trend persists indefinitely. It's nearly impossible to know when these trends could change. So, whether this is a short-term period of strength for the South African markets or the start of a longer trend, only time will tell. It is for this reason that being well diversified in your investment portfolio across countries, currencies, and investment strategies is key to delivering consistent long-term capital growth. Thanks as always for watching. Have a great week.